we have the geometric average. You see, it is much smaller. It is 8.3%, while for arithmetic average, it was 10%. For our example, it would look this way. 1 plus 100% times 1 less 50% to the power of 1 over 2, or we can simply take the square root out of it, and we will have 0. Okay, this will be the result of geometric average. Okay, so the geometric average captures the compounding effect and the fact also that the money that we invest can be lost. And when we earn the next period from this one, we earn 25%, but not on the amount of money that we had at that moment. We earn this 25%, but on the amount of money that is reduced due to the negative return that happened earlier. Okay. So if we want to calculate some central tendency for returns with the compounding effect, and if we consider time series, it is much better to use geometric average. Sometimes, however, it is accepted to use arithmetic average, but only if the returns are not volatile, are quite stable. If they are very, very small, for example, daily returns, if we speak of 4 daily returns, then the compounding effect is not that much. And if the positive and negative returns are not mixed, so if we observe consistently positive returns. In that case, the difference between geometric and arithmetic average would not be great. It will be marginal. So it is acceptable to use arithmetic average. The arithmetic average, however, can be also used for other purposes. For example, if you have $1 million, and you invested $0.25 million in a stock, 0.25 in gold, 0.25 in bond, and and the last 0.25 in cryptocurrencies. And you hold these for one period, a week or month or year, you don't care. But then you want to calculate your average performance. But here you want to compare your average performance, however, depending not on compounding effect, but on the distribution of performance across asset classes. And in this case, you can perfectly use arithmetic average or weighted average if these weights are not equal, for example. Okay. So if you want to know your overall result, knowing that you have different asset classes and they perform differently because crypto could lose a lot, bond could earn somehow, gold could earn a lot, and stock could earn some decent return. These differences in returns exist, but you want to know the average return, you can use arithmetic return or weighted average return. Now, okay, this is another example. I will not explain it in detail. You can get to this example back at home because it is similar to the example we had with the $1 million losing and earning and losing in the end. But it shows you that the geometric average is close to very close, exactly the same as multiple holding period return. Now, when you go to data vendors, to portals of finances, you can often get information on cumulative average growth rate. So CAGR It is the metric often reported for instruments, for stock, for other assets, and this represents average annual growth. However, it is often calculated exactly as geometric average. So, although it is called cumulative average growth rate, please remember that this is not arithmetic average, this is geometric average. And this rate is often used for comparisons of between time periods and between asset classes. Now, we can go to harmonic mean. This is another way of finding the central tendency. This is the reciprocal, or the average of reciprocals of reciprocals. So our returns are here. Here are our returns. We get the reciprocal of the returns. Then we calculate the average of these reciprocals, and we get the reciprocal of the average. This is harmonic mean, in easy words. Now, why is it useful to know the harmonic mean in finances and portfolio management, especially when our variable is a ratio or rate, so rate of return? And sometimes it can be seen as a special type of weighted mean. However, here in our course, I want to highlight the specific investment style where harmonic mean is used to understand the average return. So let's see a very interesting thing. The outliers influence in harmonic mean are much smaller than in the arithmetic or geometric mean. So if we have the outliers and we want to smoothen our results, we also can use the harmonic mean. However, let's go to this strategy, that I've just signalized. This is the strategy of investment, which is called cost averaging, and it is often used by individuals. So the cost averaging means that an investor makes a decision to dedicate periodically a fixed amount of money to buy the same asset. Think of a stock of American Micro Devices. This is the company that observed a significant growth last month. However, this is the company that exists for some years. And the investor could have the strategy to allocate $1,000 every month to this stock. It is quite reasonable because some investors, they simply save money and they buy stock to save for future. And saving strategy means that they decide that some amount of money every month, every year will be set aside for saving, for investment. So if the fixed amount of money is saved, and the price of the instrument changes, the cost of the investment changes. So let's check this example. We have an investor that invests €1,000 each month in a particular stock. And we have the time period of 2 months. Okay? The share prices in this first month will be €10, and in the second month, it will be €15 on 2 purchasing dates. So it can be actually American Micro Devices because the price jumped by 50% in October. Okay? So the question is, what is the average price paid for the security? One would say that, okay, I think it's 12.25, right? Is this the average price? No, actually, the price is different. Think of how much he paid. This is the application of the harmonic mean. On the first month, the investor saved €1,000, dedicated this €1,000 to buy shares, and if share costs us €10, it is possible to buy 100 shares. Now, next month, the investor again had 1,000 euro. However, as the price of stock increased, the investor could buy only 66.67 shares. So overall, the investor dedicated 2,000 euro to acquire 166.67 shares. So in total, 166 shares for 2,000 euro, and the average price is 12, not 12.5, because we think that the average price is 12.5. And the harmonic mean informs us. Actually, this calculation here is the simplified version of the harmonic mean. Now, let's think of another mean, the trimmed mean, When is it important to use the trimmed mean? When we have the outliers. For example, let's think of the returns, the rates of return for gold. The rates of return for gold have a not normal distribution, meaning that they are platycortic. What does it mean? Platycortic? We don't know yet, okay? So let's see that this is the average daily return on gold, or weekly return, average weekly return of gold. Simple rate of return, average simple rate of return for gold is this, okay? And this here we have the number of observations, number of returns that were around here. And in case of gold, we will observe some very small numbers here and few very high numbers and some average. Okay, I should make it like this maybe. Oh, this is better, sorry. What I mean is that we have some central observations and we have positive outliers. So random large positive returns and also random large negative returns when it comes to this investment. And our average does not inform us about the existence of these outliers. So if we observe the historical returns for gold and we see that there are extreme negative or extreme positive outliers, we might ask ourselves a question: will this happen again in the future? And the answer is, well, if the unstable political situation persists, yes, if there's some, let's think of events that drive these positive outliers. Maybe the event that drives the positive outlier is the election of Trump or the imposing new tariffs. And what are the events that trigger the negative returns, extreme negative returns? Maybe the announcement of application of new technology in industry, which drives all the investor to stock. Or maybe very good data on consumption and employment in US that drives all the investor to stock market. This can result in negative returns for gold. So we might ask ourselves a question: is it likely that these events, here we have Donald Trump and tariffs, double T, here we have good consumption data, are these events likely to be repeated in the future? That we want to, if we want to know the central tendency, we usually do it, we usually want to use it for expectations, for shaping our expectations. If we don't believe that these extreme observations will be repeated in the future, these outliers may somehow distort our understanding of the average. It can be moved upwards or downwards. So if for financial data, for rates of return, there are some extreme positive observations and negative observations, if they are triggered by historical events that are not likely to happen again, then we should get rid of these outliers because they give us the false picture of the average. So the trimmed mean is obtained by removing some fixed percentage of the smallest and largest values. We have to decide on what is the fixed percentage, 5%, 10%, 20%, no, too much. I would say that 5% can be done for stock, 10% maybe for some cryptos. It depends on the asset classes, right? But after the trim is done, after the observations are removed, the arithmetic mean or geometric mean is calculated for the remaining observations. Okay, this is the trimmed mean. So the trimmed mean will always smoothen the results. However, it will be calculated based on smaller number of observations. The another approach is so-called Winsorized mean. The starting point is the same. There are some outliers, some extremely negative or positive returns that we believe are not likely to happen in the future. However, instead of removing them completely, we again set the threshold, like 5%, 10% of top and bottom values, and we replace these negative or positive outliers with the closest value. So, for example, if we have very small loss, now we have normal distribution and some positive gain here, very positive gain here, okay? This is our histogram for returns on stock. And this is, okay, this is the left tail. This is our negative distribution, negative low observation is here, and the closest one is here. We remove this observation, replacing it with the closest observation, and the same for positive returns. So we pull extreme out values, however, we do not reduce the number of observation. This is Winsorizing means. So we keep the full data set. So we assume that there can be the downturns in the future, but they will not be that heavy as they were observed in the case of past. Okay. So if there are, for example, some crises in corporations' reputation, we see the negative returns. We assume that there will be negative returns in the future, but not that great. Okay, this is the idea of the Winsorized mean. Now, let's go to money-weighted return. This is a very important concept for portfolio managers. Okay, portfolio managers are people who manage the funds that are provided by investor, the clients, and withdrawn by the clients. So the portfolio manager is not fully responsible for how much money is actually allocated in the fund, because this is the decision of the clients to contribute to the fund or to withdraw from the fund. Still, the amount of money provided significantly affects the value of return earned. Because if you have a lot of money, in good times, you earn a lot. But if you have little money in good times, you earn little. Okay? And you are not fully as portfolio manager, you are not fully responsible for how much money you have. Also, for individual investor, it is important to understand how much the return earned is due to the selection of assets to invest in, and how much is due to decision when to invest and when to withdraw. If we invest in bad times, this is bad decision. If we invest in good times, it is good decision. If we divest in good times, this is bad decision. If we divest in bad times, this is good decision. And the money-weighted return is the return that captures this dynamics. So let's take a look at the example. Let's have 3 years of observation. In year 1, we have a fund, a portfolio. This is the portfolio management, and invest in some, let's say, ETF. This is the ETF for Krakow, let's say, for companies that operate in Krakow. In the first year, it lost 50%. In second year, it earned 35%. In the third year, it earned 27%. So we can calculate arithmetic average, which is positive. We can calculate geometric average. It is a negative. However, these averages will not show us the overall effect, which depends also on the amount of money invested. If it is just 1,000 euro, we will have exactly the result from geometric average, and if there are no additions or withdrawals from the fund. However, if we invest 10,000 euro at the start, then 1,000 euro in year 1, 1,000 euro in year 2, we will lose 50% of the initial investment, and it will hurt us a lot. And then we will earn 35, but on much smaller amount of money. Conversely, if we invest 100 at the start and then invest 1,000, then the absolute effect of this first loss will be much smaller. And the effect of this big loss on the total return, which will be much smaller if we invest little at the start and a lot later years. So how to calculate money-weighted return? This is the concept closely related to net present value. We simply calculate the value of the cash flows, where cash flows are the money contributed to the fund. This is the inflow. If investors withdraw money from the fund, the cash flow is negative. If they invest again, the cash flow is positive. And at the end of the investment, we assume the liquidation of the investment and the withdrawal of the assets. So this is the cash outflow from the fund. Let's see the example. We assume that the investor invested 100 in the mutual fund at the beginning of the first year, then added 950 at the beginning of the second year, and withdraw 350 in the end of the second year, and after the third year, withdraw from the investment. So what is money-weighted return? We have to build a cash flow. This is not cash flow statement, obviously, but a cash flow report for this investment. So we start having 0 euro. At the beginning of the first year, investor invests 100 euro. So this is the net balance. Then the investor suffers a loss of 50%. So in money terms, the investor lost 50 euro. And in the end, the investor of the year 1, the investor has only 50 euro. So the investor starts a new year having just 50 euro. However, adds 950 euro. So the beginning of the second year, at the beginning of the second year, the investor holds 1,000 euro. The rate of return is 35. So having 1,000 euro allows the investor to earn 350. And in the end, in the end of the year, the investor withdraws 350 euro. So next year, the investor starts having 1,000 euro, holds this 1,000 euro, The return is positive, 27%, so the investor earns 270 euro, and in the end, the value of the investment is 1,170. The investor can liquidate the asset. So this is the contribution of the investor. It is signed plus from the investment. Again, this is the another contribution, the beginning of the second year, cash inflow to the investment. Then the investors withdraw the money. This is cash outflow from the investment. And in the end of this third year, the investors liquidate the investment, and this is the cash outflow. So to calculate the money-weighted return, we need to get information on these inflows and outflows. Here you can see this is this inflow in beginning. This is this. Sorry, this is cash in. This is from the okay. This is the portfolio point of view, and this is the investor point of view. The investor gets the money out of the wallet. So the investor has cash outflow. Now the investor liquidates, adds additional 950. So again, gets from the wallet, gives to the fund. So this is minus. Then investor sells part of this mutual fund. So this is the cash inflows the wallet of the investor. And finally, the investor liquidates the money, the mutual fund, and there is the inflow to the investor wallet. And we can draw it as a formula. Draw it as a formula that we have here. This is the formula that we can use. So our formula is that our first cash flow is minus 100. Then plus minus 950 over 1 plus this is IRR, but I will call it money weighted return, because money weighted return is actually internal rate of return to the power of 1 plus 350 over 1 plus, again, money weighted return to the power of 2 plus 1,270. This is the last cash flow over 1 plus money weighted return to the power of 3. And while solving for this unknown number, we will get our internal rate of return, which is actually money weighted return. The technique is the internal rate of return. However, in terms of returns, the investor's investment, financial investment, this is not investment in building a factory. This is not investment in intangibles. This is financial investment. And in this case, it is called money-weighted return. This money-weighted return shows us two aspects. First of all, it shows us what were the returns. It were minus 50, 35, and 27. Geometric average is minus 4, arithmetic average is 5. However, the investor was clever because the investor added only 100 in bad times and added a lot, 950 in good times. Then it was not so good decision because the investor withdrew 350 also in good times, and all of it is reflected in this overall money-weighted return, especially the intelligence of the investor not to invest in the bad times and invest in the good times. Okay, so it shows the effect on the return of two problems, two mechanisms. First, the change in the returns earned, but second, how much we invest. This is the money-weighted return. Now, the time-weighted return, well, if you are a portfolio manager, and you are not fully responsible for how much money you have in what year, because this is the decision of the investors, then you want to know the time-weighted return. And the time-weighted return is the return that is not sensitive to additions and withdrawals of funds. It is similar to holding period return, but it is not exactly the same. So it measures the compound rate of growth of $1 initially invested in the portfolio, and not all the dollars initially invested in the portfolio. So to calculate the time-weighted return, we do it if we want to neutralize the effect of cash additions and cash withdrawals to the portfolio, which are outside of the control of the portfolio manager. So how it is done? First, the manager should price the portfolio prior to any significant additions and withdrawals, break overall evaluation period into sub-periods, then calculate holding period return of the portfolio for each sub-period. So at the beginning, we can have $1 million. This is for sub-period. Our sub-periods can be, let's say we have, again, 3-year period with 1-year sub-periods. So we can have $1 million. We calculate the rate of return for the first year. Then there are another additions at the beginning of the second year, and at the beginning of the second year you have $3 million, but you calculate the holding period return just for the second period, assuming that the 2 million is the initial beginning value of your fund. And again, in the third period, there can be some withdrawals. You have just $1.5 million. You calculate the holding period return just for the third period. And then you take just this sub-periods holding period returns and you do the holding period return. The example, we have the portfolios that earn 12% the beginning, it should be 12 here, sorry, 12 should be here, yes, because 12 is here in our formula, okay? Next, 6.67%, and the time-weighted return is just, as we have two periods, it is the square root of the multiplications of the holding period returns. If we had 3 periods, then we would use the cube root of the multiplications of 3 holding period returns. Then, annualizing is also very important because sometimes we hold the investment for the whole year, sometimes we hold the investor for 2.5 years, sometimes we hold the investor for 3 months or 3 weeks. And the annualization is very important to get the average annual rate of return because it is very often used for comparisons across asset classes. Moreover, more complex models like Black-Scholes option pricing model, they require annualized returns and periods. So they want these returns to be in years. So if you have the investment that lasts for 7 months, you need to somehow extrapolate the results to get the annualized rate of return. And this is financial mathematics. And I will not go deeper into this. I just want to remind you that this is the technicality that we should also remember about. Now, how much time do we have? Would you like to... Now I will just refer to one very important fact about the returns and the difference between simple returns and logarithmic returns, okay? And then we will have a short break. Do you agree?
Yes.
Yes,
Yes?
that's okay.
That's okay. Okay, so our returns are usually time series. So we have like 911 data points, and each of the data point refers to daily return or weekly return. So, or we know the prices of the closing prices of instrument, daily closing prices. How to compute a return? Well, we can do a simple return. For example, if we have a closing price on day 1 and closing price on day 2, we can calculate simple return, simple way, closing price day 2 less closing price day 1 over closing price day 1. This is the simple rate of return. However, it is not additive. Now, what is the problem? Simple rate of return and simple rates of return are very important to understand the distribution of returns. Such simple rates of return are later on analyzed using standard deviation, semi-deviation, histograms, building skewness. Cortezes will explain some of these concepts and how they are used to understand the rate of return. However, these returns do not add up, okay? And they cannot, and they are not normal. And for many financial models, we need to get some normalized returns because these models often assume normal distribution of returns. Just mentioned Black-Scholes models, but also other models of modeling future returns like Gauge models, ARIMA models, they require normalized returns. So there is one technique that the analysts often use. They, instead of calculating simple returns, they calculate logarithmic returns. These logarithmic returns, they again assume continuous compounding. Is it especially important for stock? Because the value of stock changes continuously in microseconds, right? So it's like, it's not a discrete change in the price, but it is like a flow of change in the price, a continuous change. So the continuously compounded returns are captured by natural logarithm of returns. How it is calculated? This way. So natural logarithmic, this is so-called logarithmic return. Logarithmic return is natural logarithm of price in the ending date over the price in the beginning. It is like a natural logarithm of 1 plus this simple rate of return. And interestingly enough, these natural logarithmic returns, they add up. So they are very good in making forecasts. Maybe I will show you the example. One example is here. Oh, one very important thing. Maybe someone was waiting to be accepted for. No. Oh, okay. Simple example. Yes. Okay. Oops, zatrzymaj. Stop sharing and share different thing. You can see this is already calculated. Here we have the date for stock. This is for Orlen, Polish company, and this is for 1 month. It starts in the end of July. Not 1 month. It is 50 data points on closing prices. So it starts in the end of July 2025. It ends on the 9th of October 2025. 50 data points. Here we have closing prices. The beginning price is 83.66. The closing price in the end of the observation, so in the mid-October, is 88.88. Now, I calculated simple returns in this way. You can see simple returns calculated, simple returns calculated. Then I calculated the arithmetic average of simple daily returns. And then I used this arithmetic average to forecast the closing price on the 50th day. How did I do it? Well, you have the formula here. Future value is always present value times 1 plus R. R is the rate of return to the power of n. Future value should be the price of Orlen at the 50th day. The beginning value is here, 83.65, 60 something. The R should be the arithmetic average of daily returns. N is 49 because we have 49 time steps. And yet the result is 89.74. So it is overstated. It is much higher than the closing price on this 9th of October. So the arithmetic average is useless and the discrete compounding is useless to calculate, to model, to forecast the future value, even if we have the data. Now, how the log returns work? I calculated log returns. You see the natural logarithm of the relation between future price and earlier price. These are the log returns. I calculated the arithmetic average of the log returns. And here I used the formula for continuous compounding, where the future value is the present value times the exponent times the rate of return and n. So present value is always this, the beginning of our observation. R will be the arithmetic average of log returns. N, again, is 49 because for 50 closing prices, we have 49 day changes. And the result is 88.88, which is perfectly the same as the closing price on the 9th of October. This is how logarithmic returns add up. This is what we call the additivity of logarithmic returns, and this is why logarithmic returns are used for modeling purposes. Now, I stop this, and I go to our presentation, which is here. You see, here we have at the bottom of the slide, you can see, oh, I didn't want to delete it, okay. This is the formula that I use to forecast the closing price for Orlen, knowing the average logarithmic return and the number of periods, which was in our case 49, okay. In this case is, I think, 1. So it is much more accurate, okay. However, it is the log returns, although they are very useful in modeling, they are not used for understanding the distribution of the stock returns or financial instrument returns, because distribution is usually not normal. So we have to understand this lack of normality for the distribution. Now, okay. There's another topic, risk. So now I will stop sharing the screen, right? And we will have some break, okay? I need some more water. And let's see how many minutes you need for a break?
15 minutes.
15? Okay, so I have to speed up later on. Okay, we will try. So let's meet in, where's the chat? Let's meet in 20, okay, 20. Let's meet in 2020, okay? And let's share the file. Yeah, I will upload the file to our Moodle, okay?
Sure, thank you.
Okay, so see in some minutes. So welcome back, and let's start discussing risk, okay, of investment. All investment is made with the hope to get the return. However, the result can differ from what was hoped for. So here we are with the concept of risk, okay? Now, probably if I asked you a question of whether you want to have a gold mine, the students usually answer that they want to have a gold mine. But please take a look at this chart. This chart shows us the value of equities issued by the Newmont Corporation, which is a gold mine. And as you can see, there were periods where investors in the Newmont lost more than half of the value of the assets they invested in the company. There were the periods of big increases and the big losses. And I'm sure that these investors suffered from a big headache during the period of losses, not knowing whether the company will get back the value lost during these periods. So the headache that the investors suffer from is a kind of disadvantage of investing. The return is the advantage, but the headache is the disadvantage, and the headache is the greater if the risk is the greater for the investment, if the volatility of the underlying asset is greater. So here we come with the concept of risk. Now, take a look at this chart. Again, here we see the value of Newmont Corporation. This is the value of Newmont Corporation. This green and red bars, these are candle bars. This is the Newmont Corporation. And below, you can see the purple chart that shows the value of Walmart. And as you can see, they start in a very similar value. The investors holding some free assets in I would say, January 2017 could select either to invest in Walmart or Newmont Corporation. If their investment horizon holds until February 2024, they ended up in the similar values again, somehow Walmart overperforming Newmont. While think of the headache. Which investor suffered more, the investor in Walmart or in Newmont? Obviously, the investor in Newmont suffered much more than investor in Walmart, because the volatility for Walmart was much smaller and there wasn't big drops. There were drops, obviously, but there wasn't as big as for Newmont. Obviously, for Walmart, the big increases also were not observed. Still, the result of the investment is very similar. So I would say that I prefer to invest in a grocery than in the gold mine, because the results in terms of rate of return are good, comparable, while the risk is much smaller for the Walmart. And I don't want to have a headache and sleepless nights. So let's talk about the risk. There are two different concepts, risks and uncertainty. The risk is a situation where the possible outcomes are known. For example, in terms of investment, it is the increase or the decrease in value of the investment. Moreover, the probabilities of these outcomes can be measured or estimated, so we can get the idea of the potential range of outcomes. So the risk is something that is measurable due to the data access, and knowing the risk, the investor can manage it, mitigate it. So to manipulate the risk profile or this risk magnitude or time of exposure to risk, there are different ways of managing the risk. It can be done through diversification, hedging, insurance, asset liabilities management, and other. While there is also uncertainty, Uncertainty refers to situations where the possible outcomes are unknown. We don't know what will be the effect of space technologies on the market. We don't know what will be long-term effect on climate change on the market. We cannot measure any probabilities because we do not have history for these aspects. We cannot predict accurately the outcomes because there's no historical data. So uncertainty is unmeasurable, driven by unknown events, and cannot be fully mitigated. There's only one approach that investor can take in front of uncertainty. It is flexibility and adaptability. Simply accept the reality as it is and try to adjust. So in our course, we will focus on risk, remembering that there is uncertainty. However, we do not address uncertainty in our course. So we have to distinguish two very important types of risk in investment. One is called systematic risk, and other is called specific risk. Systematic risk is a risk that all assets or the whole asset class is exposed to. So if we invest in this asset class or in the market, we cannot eliminate the risk through diversification because no matter we go to stock A, B, or D, they are all exposed to the same risk. Think of, again, the data on consumption in US or unemployment in US. If the data of unemployment in US come and they are bad, the whole Standard & Poor's is in red because all companies lose their value as investors adjust their valuation to the upcoming data. So this is the risk that hurts everybody in the market. And you cannot choose whether to go to stock A or stock B. You will be affected by this risk. This is systematic risk, often related to macroeconomic factor or overall market behavior. While specific risk is specific to the company, sometimes to industry or sector, it can be reduced through diversification. So, for example, if company invests heavily in a new technology and there are some risks related to this, then this is the risk specific for this company because other companies don't do that. They do not invest in this particular technology. Okay, this risk can yield an increased return in the future, but it can also result in losses. Okay, so the risk is always something that can benefit the investor or can hurt the investor. Okay, so let's speak a few words about the systematic risk. These risks are interrelated. So the first typical systematic risk is a market risk where there are some losses or increases in the overall market because there are some movements usually caused by investor sentiment or economic trends or global events. The demand shifts and the whole market is in green or whole market is in red. So if there are some news rumors about the recession, about the war or other things, the investor sentiments change, and this affects the whole assets, all assets in the market. Well, systematic risk is not concept exclusively related to equities. It is also related to other asset classes. Think of bonds. Bonds are especially sensitive to changes in the interest rate. If interest rate increases, the price of bonds decreases, obviously, all bonds, because interest rate is the benchmark element of the yield to maturity for all bonds. We will learn more about it next semester. So this is no matter which bond you choose, whether it is municipal bond or corporate bond, whether it is bond issued by a utility corporation or high technology corporation, the interest rate increase will hurt it the same way. No, maybe not the same way, but they will hurt it, all bonds. Now, also inflation, as it erodes purchasing power and real return, affects all returns. And it affects particularly bonds, money market instruments, but also stock because it affects the expectations regarding future earnings of the company. Also, the currency risk. If now American investors start to expect the decrease of euro value or Polish zloty value, they will divest from European stock and Polish stock, and this will hurt the whole market. Also, obviously, economic downturns, obviously, geopolitical risk. If the market enters into political instability, wars, or significant policy changes, this disrupts markets. For example, if European Union now decides for increasing taxation of all corporations, this will have an effect for all equities listed in European markets. All will be losing their value. And we cannot escape this risk. If we are in the market with our money, if we invest with our money, we cannot escape this risk. While unsystematic risk can be avoided or diversified. And the systematic risk is specific for a given asset, the company's equity or particular bond. For example, if a company enters into the risky mergers and acquisition process, it affects the stock valuation, but also it affects the credit risk for bonds issued by this corporation and has a direct effect on returns earned on these assets by investors. And this can be diversified. For example, if you are interested in IT or telecommunication, you could invest in Nokia. You would lose money once Nokia lost market share for Apple. But you could diversify this risk by investing simultaneously in Apple and Samsung, because Apple and Samsung gained on Nokia losing the market share. Okay. Then typical unsystematic, so specific risk is also the leverage of the companies. Companies with high debt always are more valuable to downturns, interest rate hikes, and this affects their valuation much more than for other companies. Then the sectors are also exposed to sector-specific risk. Think of risk related to healthcare protection, or chemical industry, or transportation industry, or banking industry. Well, now in Poland, we all know about increase in the taxation on banks. All banks were in red in WIG index due to the increase in corporate income tax on these institutions, while other sectors weren't, because other sectors weren't hit by this regulation. So it was systematic for this market segment, which is bank, but not for the whole market, not for the broad market. It was sector specific. Then regulatory risk can be targeted also to companies. Companies sometimes need licenses. Companies sometimes need the permissions from the government, from local governments. If these permissions are not granted, for example, to build something, the company suffers losses. And finally, management risk also is particular for the company. When students learn how to deal with the event study, with understanding how the event impacts the valuation of the company, one typical example is the announcement of CEO to go for retirement. This is a specific risk for the companies. For some companies, it will result in increase in valuation. For others, it will result in decrease in valuation. But this is the risk specific to the company. There are obviously other sources of risk in investment which are not related neither to systematic risk nor to specific risk. It is not related to changes in prices, but to the situation in the market and investors' decision. First of all, very important risk is the liquidity risk. It is related to difficulty or easiness in selling an asset quickly without the significant changes in the prices. This liquidity is often measured with the bid-ask spread. And yes, for a stock market, it can be like decimals, but for high yield bonds, meaning the junk bonds, it can be even 11% of the whole total value. So if the liquidity risk increases, it can have a really big impact on the return. Then the risk can be related to poor investment strategy. If investor is overexposed to single asset, single instrument, single currency, then this is the problem of the investor, and the risk of the portfolio, which is due to investors' poor decisions. Then there are also event risks, which are not macroeconomic trends, but rather natural disasters, pandemics. Now we can hear about the hurricanes in Thailand. These are not market events, but have a big impact on the whole market. And finally, behavioral risk. The investors can make poor decisions, not just through overexposure, but because they may be overconfident, or maybe they may go to panic selling, or they may follow a fashion or hoarding behavior, and this also can yield additional risk for their investment. Now, what is the relation between risk and return when it comes to investors' utility? This relation is often graphed in so-called indifference curves. Indifference curve means that an investor, the investor can choose or investment X, which gives low risk and lower return, or investment B, which gives higher risk and higher return. But if there is investment C here, this is the investment which gives lower return than the investment B with a higher risk, and obviously investor would prefer investment B over investment C. If we have investment D here, the investment D also will give lower utility to investment B, because it can yield the same expected rate of return, however, at a higher risk. So for these investments, the risk is the same, but the rate of return is higher for B. For these two investments, B and D, the rate of return is the same, but the riskiness for B is lower. This is why the investment positioned in a high utility curve will always be preferred by rational investors to those that are positioned at moderate or low utility indifference curves. The investor's utility can be calculated using a simplified equation where there are three elements of this equation. Expected rate of return, standard deviation, which or this is variance. Sorry, this is in this formula I have variance. We will not be using this formula. This is just a model that tries to capture the dynamics, but this captures the risk and so-called risk aversion coefficient. And this risk aversion coefficient is different for different investors. Some investors are risk averse, others are not. And now please tell me your opinion about this fact. We know that individual investors might be risk averse. They may prefer safer investments over riskier investments, regardless the profitability. But what do you think of institutional investors, like insurance companies, banks, mutual funds, hedge funds? Is it possible to say that they are risk averse or not? How do you think?
think, for example,
If they diversify their portfolio so they can utilize more risk.
Okay, but also the risk aversion is an attitude which is regardless the portfolio diversification. I had an earlier student, because I cannot see you right now, I can see only the presentation. And there was a student who started at first. Who was this?
Me. I wanted to say that, like, for example, insurance companies and mutual funds, they're basically in the risk market. So their appetite to take more risk is a bit higher compared to an individual.
So you would say that these institutions are not that risk averse?
They are to a certain degree. They wouldn't, like, let's say, for example, insurance companies, right? If the risk is high, they charge a high premium. So
they always charge. Well, okay, we are not speaking about the insurance business. We speak about the investment activity of these insurance companies because they have a lot of money and they invest it. And I'm not speaking about charging premium from the clients that insure their cars or homes, but we are speaking about investment strategy of these institutions. And the question is, are institutional investors purely rational and they exchange risk for return? Or maybe they are risk averse and not always willing to accept additional risk, even if it is rewarded with a higher rate of return.
For example, maybe for pension funds, they are usually quite conservative in their investments, where they do manage large funds, but those are the, let's say, pensions of the people who have invested in those. So those organizations, I think, would be more risk averse than, let's say, a private investor, maybe.
Yes, you're right that the problem is the responsibility, because we know that the risk aversion for individual investor is a simple thing. It is a headache that we get from investing in risky instrument. And the investors prefer even worse risk return profile just to avoid the risk. And we can do the exercise for this, but we don't have much time. For individual, any risk is a cost, and individuals try to avoid them. But for institutions, the risk is also a cost. And there's no pure exchange between risk and return for institutional investors because they have to take the responsibility and they have to manage the risk. So, first of all, any risk they take has to be managed, and this is costly, reported, mitigated, reported to regulators, reported to clients, explained to clients, and there has to be the responsibility. And these are the costs. There are lots of these costs related to risk management and financial institutions. And because of this, the institutional investors are also risk averse to a certain extent. They are not purely rational investors where any increase in risk is accepted if rewarded by the increase in the rate of return. No, they will not accept any risk, even if it is rewarded, because there are costs associated with accepting the risk, okay? So even institutional investors are risk averse. Now, let's go to the next slide. And we can have different investors. Some of them will hate risk and their indifference curves will be steeply sloped, while others can be indifferent regarding risk. Their indifference curve will be stable, fixed. We also have risk lovers. There are investors that seek for risk. That deliberately go into the risky asset classes because the risk increases their utility. This is, I would say, not standard, but it happens. And if risky uncertainty lovers, risk lovers have this declining indifference curves. I will skip this and I will go directly to measures of risk. And there are two measures of risk: standard deviation and variance. I purposefully show you two different notations. Standard deviation is often abbreviated as SD or sigma. Variance is SD square or sigma square. You know the statistics, so I will not repeat how to calculate the standard deviation or this variance. We will directly go to how the standard deviation is used to understand riskiness in investment and what are the pitfalls of the standard deviation. We have to understand it because standard deviation is a key element of many financial models, and knowing the drawbacks of the standard deviation, we are aware of the drawbacks of the models. So let's go. I will skip this. Now, one important thing when it comes to standard deviation is that standard deviation shows the volatility of stock. And the greater the volatility of stock, the lower is the utility for investor. The volatility should always be rewarded with the increase in rate of return. And there's one very important ratio, the Sharpe ratio, that explains if the volatility is rewarded with increased rate of return or not. The denominator of this ratio is as follows. Here we have the annual return on stock. Here we have the annual return on risk-free instruments, in this case, treasury bill. Our denominator is annual standard deviation. Obviously, Sharpe ratio can be calculated also for monthly returns, monthly standard deviation. We can calculate a rolling Sharpe ratio. However, the classical definition is for the Sharpe ratio. And it shows risk-adjusted returns. So it helps investor to understand whether the investment returns are good regarding the risk taken. If they're actually rewarding the risk, comparing the Sharpe ratio to just annual rate of return shows us whether the annual rate of return is due to good decisions or maybe due to excessive risk taking. Okay. The higher Sharpe ratio, the better is so-called risk-adjusted performance. The negative Sharpe ratio simply means that the annual returns are smaller than the risk-free rate, so the risk should never be taken. Okay. So here's the interpretation of Sharpe ratio. The higher, the better is the interpretation. And maybe I will show you something. Maybe I will manage to show you this. Or maybe I lost it. No, I lost something. I cannot show you. I cannot show you because I didn't save one thing, okay? However, it is possible to calculate rolling Sharpe ratio or the Sharpe ratio for different assets. And let's assume that we have Sharpe ratio for stock A, and rolling 30-day Sharpe ratio for stock A is this. Here is,
sorry,
yes,
but I don't know if you want to share the screen, but we don't see.
you cannot see. Okay. Okay. Because I wanted to show other thing and I could not, so I'm clicking here. Okay. Now, what you can see right now is the example of the level of the rolling Sharpe ratio, 30-day or 60-day Sharpe ratio for stock A. Now let's try to do that for stock B. This is for stock B. Now, what does it mean? The increases in Sharpe ratio mean better risk-adjusted returns. This can be European stock and this can be American stock, for example, okay? And lower Sharpe ratio means that there is decrease in return or increase in volatility, which is not compensated by the increase in return. So the investors should observe these instruments, and if, for example, here on that moment, European stocks start to overperform American stock for Sharpe ratio, the investors should shift to European stock because here the risk is rewarded better than for US stock. And opposite here, for example, the US starts to overperform Europe. It can be due to increase in returns, for example, with unchanged volatility. In this case, the investors should shift toward American stock. Okay? So the Sharpe ratio is very good for comparisons across instruments. And now, what are the problems with standard deviation? What are the problems with standard deviation? First of all, standard deviation measures total variability of returns, whether positive or negative, while investors love positive returns. So the increased volatility due to increase in returns is wanted, while investors hate downside volatility, they hate decreases. And the standard deviation never informs us whether the variability comes from upwards or downwards. For example, if the stock swings between the return plus 25% and plus 25%, so the positive returns, it will have the same standard deviation of the one that swings between minus 20 and minus 25, even though the first is what we want, right? So there are alternatives for this, downside deviation and Sortini ratio. I will go to downside deviation later on. Another problem is that standard deviation assumes the returns follow a normal distribution. And in the real world, this never happens, because the returns often have fat tails, meaning that there are extreme events and they happen more often than as for normal distribution. The returns are skewed, meaning that there can be more downside risk than upside risk. And this means that it is possible that there are many big losses and few big gains, or opposite. There can be lots of big gains and very few big losses. This is the problem of the skewness. And the problem is of so-called volatility clustering, the periods where the turbulence is greater, the risk is greater, while these periods are followed by the periods where this volatility is much smaller. And we cannot predict these periods based on historical data because the standard deviation always captures the past and not necessarily informs us of what will happen in the future. For example, for stock returns for bank was really, really small. It changed later on. Now, let's check this, for example. Here we have the problem of asymmetry. As you can see, we have a lot of downside movements and much smaller amount of comparable upside movements. Okay? The standard deviation will not inform investor that it is more probable that the investor will lose money, have a big loss than a big increase in value. Okay? Another example, the backward looking on historical data. This is the chart that shows you the Lehman Brothers. As you can see, the standard deviation here is very small. Here is much higher, but never able to predict this volatility that is observed here. Very high volatility compared to what was before. And the past seemed to be useless to predict the future. Okay. So another problem is that for some investors, the volatility is important, while for other investors it's not that important. Standard deviation measures short-term price fluctuation. However, long-term investors may simply neglect it. It can be not important for this. So it is possible that the stock is very volatile. However, it will deliver the growth over the long term. So if we have a long-term strategy, then the permanent loss of capital matters more than the temporary fluctuation. So, for example, Amazon had extreme volatility in 2000s, but then it became very good performing investor. I will show you also another chart. Take a look at this. This is the comparison between Boeing and Intel. As you can see, the Intel has very low volatility. And for short-term investment, for example, here, it is much better to try to invest in Intel. However, assume that you are the pension fund and your time horizon is 30 years or 20 years. Then, in this case, you don't care about all these fluctuations in Boeing, because what matters for you is just the difference between this value and this value. You don't care about all the volatility in the meantime. But if you are a long-term investor, you really care what happens to Intel. In this case, you don't care for the big standard deviation for Boeing. You would prefer Boeing over Intel anyhow, because Boeing delivers the growth. Finally, standard deviation ignores behavioral and psychological factors and don't inform about how the investor will suffer from the risk. Obviously, it captures only the changes in the prices and ignores liquidity risks, systematic risk, and behavioral risks. Now, the standard deviation also works well for simple instruments like stock. However, it is unable to capture the risk of investment in complex instruments, including options, hedge fund strategies, and some complex portfolios. For these instruments, the investors describe the risk instead of measuring it, okay? And they use the implied volatility from the option pricing, models. Now, how to deal with how many minutes we have? 1 minute? Oh God. So maybe if we have 1 minute left, I will stop here. Okay. And please tell me, do you have any questions related to today's lecture? I'm aware that today was really technical, especially the rate of return. This was technical, but later on we will go to more modern portfolio theories, and you will see how it is important to properly understand the rate of return and to understand the difference between geometric mean, arithmetic mean, to understand that we speak of simple returns or log returns, okay? So do you have any questions?
Not so far, thank you.
So thank you very much for being so patient, and see you on Saturday, right? We will continue next week. Good. So have a good week, have a good weekend, and see you.
Thank you. Have a nice weekend as well. Thank you.
Thank you.
Bye.
Thank you so much. Bye.